Hello students, welcome to today's lecture. Today we are going to discuss part 2 of chapter 8 of your business studies book. The name of the chapter is Sources of Business Finance. In the first part of the chapter, we tried to understand what business finance actually means, why it is important, and how can we categorize different sources of finance. We saw that there could be different sources of finance based on time duration or period, based on ownership, or based on where the sources are originating from. And thereafter, we started understanding these different sources. In the last part, we discussed about lease financing, trade credit, and retained earnings. In today's part, we'll continue with some more sources of finance. So let us begin the class. The next source of business finance is public deposits. As the name suggests, public deposit is a source or a medium where a firm or an organization directly reaches out to the public and acquires funds in the form of borrowings. Since these are borrowings, the firm has to pay interest on the deposit. People who are interested to offer money to the company apply for the same by filling up a prescribed form. In return to their money and the application, the firm issues them a deposit receipt as an acknowledgement of the debt. The rate of interest offered on public deposits usually are higher than what is offered on bank deposits. That is why it attracts people to lend to such companies which are coming up with public deposits. So public deposits are basically a good source of raising funds directly from the public without too many formalities. Let us talk about some of its other merits. The first merit, as we've already discussed, is that it is very simple to raise funds in the form of public deposits. There is not much of a lengthy procedure involved in it. There is only a loan agreement that a company basically enters into with the public. Cost of public deposit is generally lower than the cost of borrowings from banks and financial institutions. Then, public deposits do not usually create any kind of charge on the assets of the company. So, basically public deposits are unsecured. The company does not have to pledge any assets for these loans. Then, as the depositors do not have any voting rights as such, the control of the company does not get diluted. When there are merits, there are certain demerits also, as we've seen in other types of finance sources. The demerits for public deposits are, number one, new companies generally find it very difficult to raise funds through public deposits because people usually vouch for companies which have a good reputation in the market. Companies which are big in size, which have a already built up established brand name, usually get or attract good number of people when they come up with public deposits, because these deposits, as we've seen, are unsecured. The company is not offering any asset as a charge. Then why would people go for such sources? Because people see a value in it. People see that the company behind it is already an established brand and the chances of default are very less. That is why new companies usually do not go through this route for getting funds, because they do not have a name on the basis of which they can demand deposits from the public. Secondly, these are unreliable sources, because sometimes it may happen that people may not respond at all to the call of the company. People may not subscribe to the deposits. So these are two primary demerits of public deposits. Looking at these merits and demerits, sometimes large companies go for public deposits. Apart from public deposits, another really popular document or a really popular source of finance for large companies is commercial paper. In our country, commercial papers are not new. And in our country, commercial papers have been exchanged since the early 90s. Commercial papers are also unsecured form of business finance, which are issued by usually large firms to raise funds for a short period of time. This time period could vary from 90 days to 364 days. It is usually issued by a company to other firms, other companies, other investment agencies or insurance companies or banks, etc. So these are generally not for the public. When a large company is in need of funds, it directly approaches other companies or banks, pension funds, etc., which usually have good amount of money with them. So this company basically asks money from these agencies which already have funds with them. So it is a kind of an inter-corporate financing which happens between a company and other firms or other agencies. Usually the amount raised through CPs or commercial papers is very, very large. And that's why I've been saying that these are usually resorted to by big companies. Now, commercial papers have their own merits and demerits. If we talk about the merits, then commercial papers do not create any restrictive conditions on the company because these are unsecured. These are freely transferable, so these are very liquid also. These papers provide funds as compared to other sources in a greater quantity. As we've seen, commercial papers are used for raising large amount of funds. A commercial paper provides a continuous source of funds because their maturity can be tailored to suit the requirements of the issuing firm. As we've seen, the maturity for these papers could vary from 90 days to 364 days. So these are very flexible in terms of their maturity period. Let's say, for an example, a company may issue or may go for commercial papers for, let's say, 100 days, and at the completion of the period, it may again go for a fresh commercial paper because that maturity and or the time period is very small and that too very customizable. So it provides a lot of flexibility to the issuing company. Then the commercial paper also helps the companies to park their excess funds. What do I mean by this is that those companies which have excess funds, they can actually utilize those excess funds by offering them to the companies which are issuing commercial papers. So this company requires money, it would offer commercial paper, and these companies which have excess funds with them, they can use those funds to offer their money to this company and get good return, right? So this is a good document for both parts or both sides of the exchange. But it also has its own limitations. Number one, only financially sound and large or highly rated companies can raise funds, as I've been saying from the beginning. Commercial papers are basically used by large firms because these are unsecured. These companies do not offer any security or asset. So only those companies that have a good brand name, a reputed position in the market can offer such papers because only then other firms will be willing to give them money. Secondly, the size of money that can be raised through commercial papers is limited to the excess liquidity available with the suppliers. As I've said, these companies would like to park their excess funds with these companies which are in need of them. But what this company will get will completely depend upon how much these companies have. These companies will only offer funds to this company when they have it in excess. If they do not have excess funds, if they do not want to part with their liquidity, they will not offer funds to this company. Thirdly, commercial paper is an impersonal method of financing. As such, if a firm is not in a position to redeem its paper due to financial difficulties, extending the maturity of a CP is not possible. The duration of the commercial paper is fixed. The company cannot extend the duration, so it will have to pay on maturity come what may. That also creates a kind of a burden on the issuing company. So by now we have seen 5 different types of funds or sources of funds that a company can resort to. If we recall their names, they were retained earnings, trade credit, public deposits, lease financing, and commercial papers. Apart from these 5 sources of finance, now the sources that we are going to discuss are the most important and the most common sources. You must have heard about these sources. These are shares and debentures. particularly shares. Shares are very common, especially because of the share market always being in the news. So let us talk about what shares are and how they are used as a source of finance. Talking about shares, what is a share? A share is basically the capital of the company divided into smaller parts. Let's say, for example, the capital of the company is 10 lakh rupees. If the company decides to divide this capital into, let's say, 1 lakh smaller units, then this capital of rupees 10 lakh divided into 1 lakh smaller units will be worth rupees 10 each unit. So 1 lakh units of rupees 10 basically become the shares of the companies. That means the company has 1 lakh shares of rupees 10 making up a capital of rupees 10 lakh. Out of these shares, the company sometimes can offer shares to the public or other entities to subscribe to. When either public or other entities subscribe to the shares, they pay some sort of money or some amount of money to the company in return. So shares become a very convenient and a very lucrative way of issuing finance or raising finance by the companies. But before we get into the details, let us first of all also clarify that there are two different types of shares that a company can issue. These are equity shares and preference shares. If we talk about preference shares, then as their name suggests, people who subscribe to or who buy preference shares in a company are usually given preference over the other shareholders. So preference shares or preference shareholders are preferred over equity shareholders in terms of payment of dividend or repayment of their capital, which means that preference shareholders receive their regular return, which we call as dividend, before equity shareholders get. Second, when the company is to be wound up and the capitals are to be repaid, preference shareholders are repaid before equity shareholders. Also, preference shareholders receive a fixed rate of dividend. So these are the kind of privileges that preference shareholders get. On the other hand, equity shareholders have a really big privilege that actually overpowers other privileges. That's why equity shares are more preferable or more popular. Equity shareholders offer voting rights. They offer ownership rights, which means that when a person buys equity shares in a company, he or she becomes an owner of the company to the extent of his investment. He or she gets voting rights in the company. They are called the shareholders. They are called the real shareholders or the real owners of the company. That is why people who want to become owners in companies, who want to also become part of the growth and success of a company, subscribe to equity shares. Whereas people who want to restrict their risk, receive confirmed fixed dividend, they go for preference shares. Equity shareholders do not get a fixed rate of dividend, but the upside is that when the company is earning high profits, equity shareholders receive high dividend. But the risk is that when the company is not earning good profits or not earning profits, equity shareholders may not get dividend at all. So there is risk involved in it, but since there is risk involved in it, there is a higher probability of getting higher return in it. That's why some people choose equity shares, while those who want to contain their risk, they choose preference shares. Now let us take a look at the merits and demerits of equity shares and preference shares as well. First, if we talk about equity shares, then equity shares are suitable for those investors who want to assume risk in return for higher returns, right? So these are for people who can take up risk. Secondly, payment of dividend is not fixed for equity shareholders. So this is a good thing for the company because it does not create a burden on the company. The company will only be required or expected to pay dividend when it is earning good profits. Then equity shares or equity share capital serves as a permanent capital to the company. Usually, equity shares are not redeemed or repaid during their lifetime. There is no foundation usually to repay the sum, as in the case of preference shares. That is why once a company receives money in the form of equity share capital, it becomes assured that it wouldn't be required to repay that amount soon after. Then equity capital also provides credit worthiness to the company and confidence to the prospective loan providers. What this means is that if a company has a lot of loans or a lot of preference shares as compared to equity shares, then when this company goes and approaches lenders, that is a negative impression on behalf of the company, because the company is more dependent on such funds. It has more of such funds which are to be repaid or which create a fixed burden on the company. Whereas if a company has more equity, then there is no fixed burden on the company, there is no burden of repayment also on the company. That becomes a good or positive sign or a positive a point for the company when it goes for further loans. These were the merits for equity shares. Talking about demerits, investors who want steady income, equity is not for them, because there is no guarantee of an income in equity. Secondly, the cost of equity shares is generally more for the company as compared to cost of raising funds through other sources, because when the company earns higher profits, it has to give it in the form of dividend at a higher rate. Also, the cost of issuing equity shares is generally greater. So, overall cost of equity shares is generally higher as compared to other sources. Third and the most important thing is that issuing equity shares dilutes the control of the existing owners over the company. If the owners of the company issue equity shares, they'll have to share control, they'll have to share voting rights with the upcoming shareholders. That dilutes their control. And there are further formalities and procedural delays involved as well. So, as we can see, from the perspective of the company and the shareholders both, equity shares offer certain really good advantages. At the same time, they have certain demerits as well. That's why the need for preference shares arises. Preference shares also have certain merits and certain demerits. The merits of preference shares involve or include, number one, the thing that preference shares provide a reasonably steady income is an attractive or a popular thing among the investors. Secondly, preference shares are useful for those investors who basically want to avoid risk. Third, preference shares do not affect the control of the existing equity shares or shareholders or owners. Fourth, payment of fixed rate of dividend to preference shareholders enables a company to also declare higher dividends to equity shareholders in good times. So, when a company is going through good times, it won't be required to pay higher dividends to preference shareholders. It can keep paying them the same fixed rate of dividend, but it can pay higher dividend to equity shareholders. If we talk about the demerits, preference shares are not suitable for those investors who are looking for higher returns. Secondly, preference shares dilute the claim of equity shareholders over the assets of the company, because in times of winding up, when the company's assets are being sold off to pay the liabilities and pay off the capital, preference shareholders get it before the equity shareholders who are the real owners. This dilutes their claims or their rights over the assets. The rate of dividend on preference shares is generally higher than the rate of interest on other sources of loans. Also, as the dividend on these shares is to be paid in all situations, whether there is profit or not, it is a burden on the company. So, these were the major limitations of preference shares. Equity or preference, whatever type of shares it is, shares have always been very popular among investors as well as among companies. But as we've seen, there are certain procedural delays, there are certain formalities, also there are certain limitations on both equity and preference shares. Sometimes when companies are in need of long-term funds, they do not prefer issuing either type of shares. They rather choose a different path. They rather choose to go for loans. And when they choose to go for a loan or a debt from the public, they issue a certificate. In return, they issue an acknowledgement which is known as a debenture certificate, a debenture. So what is a debenture? A debenture is an instrument for raising long-term debt capital from the public. It is a debt capital. It is a kind of a loan which is taken from the public by issuing them a debt certificate or a debenture certificate. The debentures issued by a company are basically acknowledgement that the company has borrowed a certain sum which it promises to repay at a future date. So just like a loan, debentures are repaid at a future date. So I hope you are able to differentiate between shares and debentures. Debentures are more like loans, while shares are more like company's own fund or owner's own fund. Debentures are always repaid because they are loans, they have to be repaid at a future date. Debenture holders therefore are termed as creditors of the company. Debenture holders are paid a fixed stated amount as interest at specified intervals, which could be 6 months, 1 year, and so on. A company has a choice of issuing different types of debentures. Debentures do come in different forms and varieties. The first category of debentures is secured and unsecured debentures. Since debentures are loans, and as we know, certain loans are secured and certain loans are unsecured. When a loan is secured, it means that the firm or the company or the borrower has offered some assets as mortgage or as a security in return for the loan. And when a loan is not secured, it means that the company has not offered any asset or has not mortgaged any asset. Just likewise, debentures can also be secured and unsecured. Secured debentures are secured by a charge on company's assets. Unsecured debentures are not secured at all. Secondly, registered and bearer debentures. Registered debentures are those which are duly recorded in the register of the company on the name of the debenture holders. On the other hand, bearer debentures do not bear a name, they are not recorded in the company's register, they can be easily transferred to anyone. Anyone who is holding that bearer debenture is basically the owner of that debenture, while registered debentures cannot be transferred so easily. Third, there are convertible and non-convertible debentures. Convertible debentures are those debentures on which the company offers an option to convert them into equity shares. They can be converted into equity shares later on, while non-convertible debentures are not convertible. They cannot be converted into equity shares. Finally, there are first and second debentures. Sometimes a company issues different categories or different types of debentures at different time intervals. Those debentures which are to be repaid first are called first debentures, and those which are to be repaid after the first debentures are called second debentures. So there are 4 types of categorization of debentures. First, on the basis of security, secured and unsecured. Second, on the basis of registration, registered and bearer debentures. Third, on the basis of convertibility, convertible and non-convertible debentures. Fourth, on the basis of period of repayment, first and second debentures. The merits of raising funds through debentures are: number 1, people who want a fixed income really prefer this kind of investment because debentures offer fixed interest to the investors. So that is a big advantage to the investors. They are fixed charge funds, so they do not participate in profits. That is a benefit for the company. When a company is earning higher profits, they still have to pay the same rate of debentures interest. So debentures do not participate in the profits of the company. Thirdly, the issue of debentures is suitable in a situation when the sales and earnings are relatively stable. So when a company is earning good amount of money, its sales are going really good, then it usually prefers to issue debentures because it is confident of repaying the debentures in time, it is confident of paying the interest on time. So it does not have to go with shares and dilute control. It can just issue debentures because it can easily pay the interest and the final sum as well. Debentures also do not carry any voting rights, so that is also an advantage to the company or the management. If we talk about the limitations, since they are fixed charge instruments, they create a permanent burden on the earnings of the company. Even if the company is not earning profits, it will have to pay interest. In case of redeemable debentures, after a certain amount of time, the company will have to repay the sum. That also creates a repayment burden at the end of the time duration. Then each company has a certain borrowing capacity. If a company utilizes its borrowing capacity, then it may not be in a position to issue further debentures. So dear students, I hope you were able to understand, distinguish and clarify in your heads the concepts of shares and debentures. Today we discussed about 4 types of sources of funds: shares, debentures, then public deposits and commercial papers. In the next class, we'll discuss about few more sources and finally also see how does a company decide which source is suitable and which is not. This was it for today's class. Thank you.